All right, picture this. Every single chip powering your phone, your car, your AI assistant, before any of that silicon exists in the real world, it has to be designed in software. And the company that makes that software? Synopsys.
And they just spent $35 billion to make sure nobody else can catch them. That Ansys deal closed last summer, and the integration story is the story for 2026.
Episode 138 of Charged Alpha, we're breaking down Synopsys, ticker SNPS, the invisible giant behind every chip that matters. Lana, this one's a monster.
It really is. $80 billion market cap, 77% gross margins, and a forward PE that's actually not insane for what they're building. Let's get into it.
So Synopsys was founded back in 1986, headquartered in Sunnyvale, California, right in the heart of Silicon Valley. They've got about 29,000 employees now, and their core business is electronic design automation, or EDA.
Think of EDA as the architectural blueprint software for semiconductors. Before a chip gets fabricated at TSMC or Intel, engineers use Synopsys tools to design, simulate, and verify every transistor. Without these tools, modern chip design simply doesn't happen.
And it's not just the design software. Synopsys also licenses silicon IP, pre-built circuit blocks that chip companies plug into their designs to save time. Things like USB controllers, memory interfaces, processor cores. It's like selling both the drafting tools and the prefab components.
The real game changer is the Ansys acquisition. By adding multi-physics simulation, thermal analysis, structural integrity, electromagnetic modeling, Synopsys created what they're calling a silicon-to-systems platform. No competitor offers that end-to-end integration.
So you design the chip, simulate how it performs under stress, check the thermal profile, verify the electromagnetics, all in one ecosystem. That's a pretty compelling pitch to an engineering team.
And a pretty compelling lock-in mechanism. Once a design team builds their workflow around that integrated platform, switching costs become enormous. We're talking years of retraining and requalification.
Their main competitors are Cadence Design Systems and Siemens EDA, but Synopsys holds somewhere between 38 and 46% of the EDA market. That's a commanding lead in a three-player oligopoly. Leading the charge is Sassine Ghazi, who took over as CEO in January 2024. He's a lifer, joined Synopsys back in 1998 as an applications engineer after starting his career at Intel as a chip designer. Worked his way up through product development, sales, and operations before becoming COO and then CEO.
Wall Street likes him. He steered the company through that complex Ansys regulatory approval process, delivered record revenue in his first full fiscal year, and he's a regular on CNBC talking about AI-driven chip design. His total comp package of about $19.6 million reflects the board's confidence.
Having a CEO who actually designed chips before running the company that designs chip design tools, there's a credibility there you can't manufacture.
Let's talk numbers. Synopsys trades at $420.53, giving it a market cap of $80.6 billion. Trailing PE is 64.5, which looks expensive until you see the forward PE of 27.6.
That's a huge gap between trailing and forward. What's driving that?
The Ansys acquisition. It's distorting trailing earnings with integration charges, amortization of acquired intangibles, and restructuring costs. On a non-GAAP basis, the picture is much cleaner. Q1 fiscal 2026 came in at $3.77 per share, beating consensus by 5.6%.
And revenue?
Revenue hit $2.4 billion in Q1, up 65.5% year over year. Now, that's inflated by Ansys. The organic growth rate is closer to mid-teens. But even so, the trajectory is impressive. Full-year guidance is $9.6 billion at the midpoint, up 36%. Gross margins are 77%, among the best in all of software. Non-GAAP operating margins are running at 37.3% and guided to reach 40.5% for the full fiscal year. This is a high-quality revenue stream.
Cash flow picture?
Operating cash flow was $1.5 billion in fiscal 2025. Free cash flow $1.35 billion. They're guiding to $1.9 billion in free cash flow for fiscal 2026. The balance sheet does carry $10 billion in debt from the Ansys financing, but they're paying it down aggressively, already knocked $3.5 billion off since closing.
$2.2 billion in cash against $10 billion in debt. That's manageable?
At their cash generation rate, absolutely. They're throwing off nearly $2 billion a year in free cash flow. The to EBITDA ratio is coming down quickly. Overall, Synopsys' financial health is strong. 77% gross margins, accelerating revenue, and a clear deleveraging path fund a business that's becoming more dominant by the quarter.
So what are the analysts saying?
31 analysts cover Synopsys. 19 rated a buy, 5 say hold, and 1 lone bear has a sell. The average price target is $557.86, which implies about 33% upside from here.
That's a wide range, though, right?
It is. The low target is $425, basically flat from here, and the high is $650 from JP Morgan's Harlan Sur, who sees over 50% upside from the Silicon to Systems platform. The bulls love the Ansys story.
Any notable bears?
Morgan Stanley downgraded to equal weight in February with a 480 target, citing growth deceleration concerns. Piper Sandler also moved to neutral in January. HSBC went to hold, saying there aren't enough catalysts for the rest of 2026. So you've got this interesting split. The bulls see a multi-year platform story. The bears see near-term headwinds.
Last earnings?
Q1 fiscal 2026 reported February 25th. Revenue of $2.4 billion beat by 0.8%. Non-GAAP EPS of $3.77 beat by 5.6%. Guidance was maintained, not raised, which disappointed some investors looking for an upward revision after a strong beat.
All right, let me lay out the bull case. First, the Silicon to Systems platform is a genuine competitive moat expansion. Nobody else, not Cadence, not Siemens, can offer integrated chip design plus multi-physics simulation. That creates a new total addressable market in systems engineering.
Fair point. What else?
AI chip complexity is a massive tailwind. Every new generation of AI accelerators gets more complex, which means more design tool usage, more verification cycles, more simulation runs. Synopsys is essentially a picks and shovels play on the AI infrastructure build-out.
Now the bear case. Integration risk is real. $35 billion acquisitions don't integrate themselves. They're cutting 10% of the workforce, about 2,000 people, with $300 to $350 million in restructuring charges. That's disruptive.
That's a big number.
Design IP margins have compressed to 16% from historical 30 to 40%. That's a segment that needs to recover. And then there's China. U.S. technology restrictions create ongoing revenue headwinds that are hard to forecast. At 64 times trailing earnings, the stock is priced for near-flawless execution.
So the bull story is about the next 3 to 5 years. The bear story is about the next 3 to 4 quarters.
That's a clean way to put it.
How does Synopsys stack up against the competition?
The primary public peer is Cadence Design Systems. Cadence trades at about 71 times trailing earnings with a PS ratio of 18.6, actually more expensive than Synopsys on a price-to-sales basis. Cadence is growing revenue at about 14% versus Synopsys' 36% this fiscal year, though that gap narrows when you strip out Ansys.
What about Ansys as a comparison?
Ansys was trading at about 55 times earnings before the acquisition, growing revenue at 8%. Now it's a subsidiary contributing an expected $2.9 billion in FY2026 revenue. The success of that integration determines whether Synopsys justifies its premium. Keysight Technologies is another reference point, trades at 35 times earnings with a much lower PS of 6.8, but it has narrower semiconductor exposure and slower growth.
So Synopsys isn't the most expensive name in the space, but it's carrying the most execution risk.
Exactly right.
Let's check the options market. What's it telling us?
The put-call volume ratio is 0.53. That's a bullish reading, meaning traders are buying roughly twice as many calls as puts. IV percentile is 65, which is elevated relative to the last 12 months, suggesting the market is pricing in some uncertainty around integration milestones.
Where are the big positions?
Call open interest is clustering at the 450, 500, and 550 strikes, all above the current price, which aligns with those analyst targets in the 550 range. Put open interest clusters at 400, 380, and 350, setting up a support zone if the stock pulls back.
So options traders are positioned for upside, but hedging downside protection too. That's a cautiously optimistic read.
It is, and I'd note that elevated IV means options premiums are rich right now. That's worth knowing if you're looking at the options chain for any reason.
Insider activity is interesting here. Lana, what are we seeing?
Almost entirely selling. 0 insider buys over the past 12 months against roughly a dozen sales. CEO Ghazi sold about 11,000 shares last June, CFO Sheila Glaser sold in September, and the chief accounting officer logged nearly $8 million in combined sales.
That sounds bearish on the surface.
Context matters. These are predominantly pre-planned sales under 10b5-1 trading plans, and they're happening at all-time high price levels. Net insider flow was negative 16.6 million over the last 90 days. It's consistent with executives managing concentrated positions rather than a vote of no confidence, but 0 buys is still notable.
Key risks and what to watch going forward.
5 things on the radar. First, Ansys integration execution, the synergy targets, the cross-sell pipeline, and whether they hit that 40.5% non-GAAP operating margin. Second, design IP margin recovery from 16% back toward historical norms. Third, China revenue trajectory as export restrictions evolve. Fourth, the workforce restructuring. Can they cut 2,000 heads without losing critical engineering talent? And fifth, valuation sensitivity. At 64 times trailing, any stumble gets punished.
Catalysts to watch.
Q2 earnings in late May, progress on the Silicon to Systems platform launch, and any Intel Foundry announcements that could boost design IP demand. The semiconductor cycle matters too. If AI CapEx keeps accelerating, Synopsys benefits directly.
So bottom line on Synopsys?
Synopsys is a world-class business at the intersection of 2 megatrends: AI-driven semiconductor complexity and the digitization of physical design. 77% gross margins, accelerating revenue toward $9.6 billion, and a unique competitive position nobody can replicate quickly. The Ansys acquisition is both the biggest opportunity and the biggest risk.
The metric to watch?
Non-GAAP operating margin. Management guided to 40.5% for the full fiscal year. If they hit that while growing revenue 36%, this integration is working. If margins stall below 37%, the street will start questioning whether they paid too much. That's your canary in the coal mine.
I love this quote from CEO Sassine Ghazi. He said, "At Synopsys, our mission is to empower innovators to drive human advancement."
That's the kind of mission statement that actually means something when you're the company enabling every major chip designer on the planet. It's not aspirational. It's descriptive.
That's going to do it for episode 138 of Charged Alpha. Synopsys, ticker SNPS, the invisible architect of the semiconductor age. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.